Now, one tool that's going to be very helpful for you as you are working the Wiley Plus questions is just take out some paper and write some of this stuff down. So that way you can really focus on what you are working through. Okay. And even if you don't like the T accounts right now, just bear with me and keep using them and keep practicing. Okay. So what we're going to do is I don't know if I'm going to have a lot of room, but you have your paper. I would encourage you to just have a set of T accounts for each one of these. Okay. So I might have to erase as we go, but you'll have the video and you can stop it and start it and rewind it. Okay. So number one, I want you to think about, again, these three T accounts that you have. Assets equals liability plus equity. Every single time, just to understand how these business transactions are impacting the accounting equation. Because remember, at the end of the day, how these get recorded is how the story gets communicated. And we're not communicating in individual items, right? We're recording each of the individual items to report on a bigger picture. Okay. And that's in the financial statements. So as we work through this, as you're looking at questions, let's remember the double entry system, identify at least two things that are happening. I'd like to ask, what are we getting? What are we giving up? Okay, two questions just to start with. So number one, purchased office equipment for $23,000. Well, we're getting office equipment in the amount of $23,000. So I like to say, what is an office equipment? Well, office equipment is an asset because we can use it in the future. So our asset account is office equipment. Okay, now remember, all of our assets are increased by debits, decreased by credits. So if we're getting office equipment, we want to debit the office equipment account for $23,000. What that means is we have increased our assets by $23,000. Now remember, we have to be in balance. So we either have to increase something on the right side of the equation, or we're going to have to decrease something on the left side because we have to keep it in balance. Now it says that we bought this from business equipment, so it must be a vendor on account. Anytime we purchase something on account, that means we have an obligation to pay in the future. It does not say we paid cash. Therefore, we do not affect the cash account. Instead, we are creating an obligation to pay in the future. So we're getting office equipment, we're giving up our cash, but in the future. And so that gets put into an account called accounts payable, or AP, and that is a liability. Now remember, all liability accounts are increased with credits, decreased by debits. And remember our rule, debits must equal credits. And so if that's the case, I need to credit accounts payable for $23,000. And am I in balance? A plus $23,000 on this side equals a plus $23,000 on the other side. And there is no impact to equity. That's okay. I'm in balance. So that's how I encourage you to look at each one of these. We're going to go ahead and work on number two. And then I'm going to stop for just a moment and give you a follow-up video for the rest of these. So now let's look at two. Paid $3,000 for cash for March rent. Again, draw out your T accounts and let's identify what's happening. Assets, liability, equity. Now this one says we paid cash. So that's pretty simple. Cash is an asset. If we paid it, remember, increases with debits, decreases with credits. If we pay cash, what happens? That credit of cash is going to decrease that cash balance. But it says it was for March rent. Well, let's ask ourselves, what is rent? That gives us benefit for the month, but not in the future. So that's an expense. And so we're going to have to record that as expense. Now, what I'm going to do is I'm actually going to draw this down here. It is an equity item. Remember, expense is a contra equity. Okay, so let's think about this. If I decrease my assets, I have to do the same thing to the other side. I have to decrease it. Okay, and remember, equity is increased by credits, decreased by debits. So I need to get my equity to go down. Well, how do I do that? Well, I have to do that with a debit. And so my debit, my expense is going to increase by 3,000. What that in turn equals is a decrease to my equity. And that's how my equation stays in balance. Now, again, this gets a little bit confusing, but remember, revenue minus expense equals net income. Revenues increase my equity. Expense decreases my equity. As I incur more expense or I debit my expense account, I'm actually increasing that expense. That increasing expense is what decreases my equity. So I have a negative 3,000 on the left, no impact to liabilities, and that's okay, plus a negative 3,000 in my equity. And so as a result, I'm in balance. So stop right there for a moment, spend a little bit of time making sure that you feel comfortable with how expenses work, and then we'll wrap up the rest of these in another video.